Ladies and gentlemen, good day and welcome to Kraft Ltd Q2FY25 earnings conference call. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ronak Jain from Orient Capital, their investor relations. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of Kraft Ltd, I extend a warm welcome to all participants on Q2FY25 financial result discussion call. Today on the call, we have Mr. Rajendra Gandhi, sir, Managing Director, and Mr. Ramakrishnan Pandeyala, Chief Financial Officer. Before we begin the call, I would like to give a short disclaimer. This call may contain some of the forward-looking statements which are completely based upon our belief, opinion, expectation as of today. These statements are not guarantees of our future performance and involve unforeseeable risks and uncertainty. And with this, I would like to hand over the call to Gandhi, sir. Over to you, sir. Thank you.
Thank you, Ronak. A very good afternoon, ladies and gentlemen, and thank you very much for attending our Q2 FY25 earnings call today. Let me take this opportunity to wish everyone in advance a very happy and safe Diwali. A detailed presentation and press release of our quarterly performance has been uploaded on our website, and I hope everybody had an opportunity to go through them. We closed the first half of the year on a positive note with robust performance in the last quarter, which confirm our belief of setting up manufacturing facilities to overcome supply disruptions. We achieved revenue growth of 33% quarter-over-quarter and 10% year-over-year, driven by enhanced operational efficiencies due to our own manufacturing that has boosted both the gross margins and operating profits. With the start of the festival season in the Indian market and the geopolitical situation with China, we are confident in our ability to maintain our strong and established market position in the kitchen and home appliances segment, supported by our diverse range of products in various categories. As you know, the second and third quarters are typically stronger for our business. I am pleased to report growth in both volumes and realization this quarter. Also, the balanced festive season looks promising, which was started with a strong monsoon, favorable economic conditions, and government policies. We have consistently met consumer expectations by expanding our product offerings across all categories and introducing new categories to acquire new and young customers. Our strategy of own manufacturing has started reflecting on our numbers in Q2 FY 2025. Stable raw material costs and operational leverage, mainly due to own manufacturing, contributed to an improvement in our margins. With government introducing quality control order for different small appliances will help us to boost our revenue and margins in coming quarters, as we have already created the required infrastructure for manufacturing these products and avoid the supply chain disruption. This will serve us as an added advantage over competition. The company is steadily expanding its footprint in the COFO and FOFO retail models for the Pigeon brand. During the quarter, we added 22 new stores overall. We now have 213 stores in 13 states and 54 cities. Our efforts in marketing and launching Pigeon brand retail stores are beginning to yield dividends in terms of enhanced brand visibility. Over the last few quarters, we have concentrated on strengthening our presence across diverse regions nationwide. We are confident that these consistent efforts will have a lasting positive impact on the Pigeon brand as we drive forward with our pan-India expansion strategy. Channel mix in Q2 was 28% from general trade, 40% from e-commerce, 13% from modern trade, 5% from corporate sales, 4% from our own retail. All the major channels reported double-digit growth over year-on-year basis, indicating strong widespread demand and successful brand traction This robust, broad-based growth across channels implies consumer acceptance of our products. Now moving on to Q2 FY25 financial performance. In Q2, consolidated revenue reached 418 crores, up from 379 crores in Q2 FY2024, representing a year-on-year growth of 10%. EBITDA for Q2 FY25 was rupees 49 crores compared to rupees 40 crores in Q2 FY2024, with EBITDA margins improving by 120 basis points, that is 7.7% in Q2 FY25 from 10.5% in the same quarter last year. Profit after tax for the quarter was 16.7 crore, up from 16.5 crore in the corresponding quarter last year, resulting in a PAT margin of 4%, which is slightly lower than the Q2 FY24, mainly due to the notional impact of indirect lease accounting. Moving to H1 FY 2025 performance. The consolidated revenue in H1 FY 2025 stood at 732.8 crores versus 677.5 crores in H1 FY 2024, registering a growth of 8.2% on year-on-year basis. EBITDA stood at 80.7 crores versus 63.9 crores in FY 2024. EBITDA margin reported 11% as compared to 9.4% in the corresponding period. H1 FY 2025 profit after tax stood at 24.9 crores versus 24.7 crores in H1 FY 2024. PAT margins for the period stood at 3.4%. Now I request the moderator to open the floor for question and answers. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Omkar Rane from Emkay Global Financial Services. Please go ahead.
Hello, sir. Good afternoon. Am I audible?
Yes, sir, you can. Please continue.
Yeah, sir, I just wanted to know that we were quite ambitious about reducing our working capital loan, as we mentioned in our Q1 call. Just wanted to know what's the status with that, because I can see that our working capital loan has increased and impacted on the margins.
On the overall basis for the year, we are continuously working on reducing our inventory and receivable days, and also the flow from the cash flows. But this the half year end coincides with the festival season, and so relatively our inventory and the receivables also are in line with the business trend. But overall, for the year, we believe that we will be able to reduce it and bring it very close to zero. It may not be absolute zero, but we believe that we can bring down our borrowings considerably.
Okay, sir. My second question is around our COFO strategy. I can see in our PPT that we have mentioned that we have 2 new models under the FOFO model, which is franchisee operated and owned. So just wanted to know if there's a change in strategy, or just wanted to get a better sense of it.
Models, all the stores are company owned, and we have a company owned franchisee operated model. A very small 2 stores which we are trying, and these are on franchisee and franchisee owned and franchisee operated model. But the number is very small, is only 2 stores. We are trying this model.
Thank you, sir.
Thank you, sir. We have the next question from the line of Khush from InCred Asset Management. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. Sir, first I wanted to understand what would be your depreciation number X and interest cost number X of the lease accounting for the quarter and first half?
You want the total value of our depreciation?
Yeah, so out of depreciation of 17 crores for the quarter, how much would be on account of lease liabilities for the stores that we have put?
4.7.
No, for the lease, see, there are two assets under the lease liabilities. We have retail stores, and we also have some capex that we have funded through lease liability.
Sure.
And the overall depreciation for this is 4.77 crores.
4.7. And what would it have been in same quarter last year?
Last year was 1.87.
Okay.
There is a difference of 3 crores.
And also, sure, and in the interest cost?
Interest cost only on that is 2.78 crores. And corresponding period last year was 1.1 crore.
Got it, sir. And so we have also taken in some other, there is some 2.7 crore other loss. Could you explain what is that? Is there is some provisioning around this number?
Yeah. So there is a one-time provision, or we have written off. See, we acquired a brand called Scava, and we wanted to strengthen the LED business. But as a strategy, now we have decided that the LED business remains where it is. And so, since we are not using this brand, we have provided for that, and we have written off. And there is also a supplier's credit. We had bought some machines during 2021. It was in Swiss franc. And though we paid a little prepaid two of those, otherwise it will end up paying next year. So there was a forex loss because this was supplier's credit, and at that time we had not hedged this Swiss franc. So to an extent of 1 crore was that. So this about 2.2 crores is only towards that, and the normal forex loss. Overall, there is an impact of 2.5 crores.
Got it. Sir, also, if I look at your product mix, in the induction cooktops in this quarter, we saw volume growth of 16.3%, but value growth is only 3.2%. And so first half of the year has also remained like that only, where with 13.5% volume growth, 2% value growth. So is there a deep discounting happening?
No. There is a considerable improvement in cost from the induction cooktop. So induction cooktop, there was a volatility in particularly the glass. The input of glass had gone up. It was very volatile in the last 2 years. That has come back to normal. And the second thing is most of these are electronic parts that go into the manufacture of induction cooktop. There is substantial improvement in our cost. Generally, as a strategy, most of the cost we pass on, while we retain our margin. So definitely there is a lower cost, lower realization in the induction cooktop by unit value. That's why you see that volumes have gone up and value is reasonably gone up.
And same would be the case for gas cooktops as well?
No, gas cooktop, we are actually the premium end. We have sold more of the lower end gas stoves in this period, and we are augmenting our capacities on the premium end. So there has been a sales loss in the premium end. So overall, you will see, of course, that will come back. That is not a problem.
Got it, sir. And last question is, sir, how many stores, what is the final count for the year, for the full year for the stores that you're adding? So right now we would be at 213 stores. So by end of the fiscal year, where we would be this number?
Generally, we are able to open between 25 and 30 stores. So assuming for the next 2 quarters, you can safely assume another 50 stores. So we begin the third quarter at 213. You add 260, 270 stores is where we should end up.
Okay. And for the next 2 years, you would continue to aggressively add these stores, or this will plateau somewhere?
I think the next 2-3 years we will be at least at this pace, if not accelerate this. We are seeing very good outcome of this channel, and all those things that we wanted to learn, I think there's enough learning. And so we will continue to be aggressive on opening the stores. And at the time being, we believe that we will continue to expand the stores at about 25-30 stores every quarter.
Okay. Sure, sir. I'll get back in the queue. Thank you.
Thank you so much, sir. We have the next question from the line of Sharan Shankar Narayan from Yes Securities. Please go ahead.
Hello. Am I audible?
Yes, sir. Please, sir.
Yeah. Thank you for the opportunity. I had one question regarding the channel mix. Could you just please share that?
Yeah, can you please repeat? I'm not able to understand what.
I don't know if I've missed it, but could you please share the channel mix?
Channel mix, yeah. So 28% approximately is our general trade for the last quarter.
Okay.
E-com is just a minute. 40% is e-com, 13% is modern trade, 5% is corporate sales, 4% is our own retail, then we have exports at 10%.
Okay, sir. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 on your touchtone phone. Next question is from the line of Varun from Equity Capital. Please go ahead.
Hello. Hi, sir.
Hi.
A couple of questions from my side. So firstly, the volume growth has been very subdued at around 6%. Last quarter it was 9%. So where do you see this, and is there any challenge across products or channels?
So it also depends on the base. I think we had a reasonably good base in the second quarter of last year, and so the volume growth is, it's not, and also the value also. So in terms of both volume value, I think we have grown at 10%. So there is also a value improvement in the product in the mix that we offer.
And where do you see this for the full year volume growth?
We believe that there is opportunity for growing better than what, because we are seeing the good demand for the festive season continuing post the quarter end.
Okay. And where can we see the depreciation and interest cost stabilize going forward, since most of your retail stores
capitalized for the capex, and for the store count, as we improve the number of, increase the number of stores, this will go up. Otherwise, for the overall, the capex plan is almost at the fag end.
So this for the full year depreciation, can we continue this run rate, or it will increase quarter on quarter?
No, I think this is the current run rate is where I think it stabilizes.
Okay, and the other expenses had a sharp jump this quarter of around 65 crores as compared to 45 last quarter. So what has impacted that?
I can give you a breakup of the other expenses. Of course, because of the larger revenue, we have also invested, comparably 10 crores more on the marketing spend, and the rest of the other expenses are in line with the revenue growth.
10 crores.
Sorry?
In the marketing spend, you mentioned how much?
10 crores. Okay, if you want exactly, I will tell you. Okay, other expense, marketing spend, 3 crores is over and above the normal. Freight, there is an increase of 3 crores, is linked to the revenue. Retail salaries also is about 1.7 crores, is linked to the revenue. And there is extra job work charges about 1.2 crores, is also linked to revenue. So those are, the increment is in line with revenue growth.
Understood. And last question, I missed on the write-off part and the other income loss which you mentioned.
Two major items in that. One is we have written off the brand cost that we had paid when we acquired this business of Scava.
Oh.
And the second is we had imported some machinery from Switzerland, and it was in Swiss francs. This is about 3 years back, but it was on a supplier's credit, and we had prepaid it a little, and there was a variance in the cost of Swiss francs. That is, there's a forex loss on accounting of this capital capex. So we have charged it to our P&L to that extent.
Okay. And for the full year, do you see the revenue growing at around 12 to 15%?
We are very confident of better growth than the current 10%.
Understood. Thank you.
Thank you.
Thank you. The next question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. My first question is just broadly to understand how the industry is doing in terms of kitchen appliances as a category now. How has been the demand pickup, especially in October? And how do you see the rural demand picking up in comparison?
So first, let me tell you that as a company, we believe that we'll be able to grow faster than the industry, and that is our overall objective. And regarding the demand, but continuing after the quarter, I can say the season has panned out very well, festive season, and we are continuing to see better demand than the quarter itself. So we believe that overall for the industry, the demand should be good.
Sir, could you call out any number in terms of how the industry is expected to grow value-wise for kitchen appliances as a segment in the third quarter?
We will grow at least a delta of 10% over and above the industry growth. So we believe that the industry would have not grown to the extent one would aspire in the first half. But then going forward, I think we are seeing good demand. So probably the industry also should be growing better than what it was in the first half.
Understood. And sir, can you give us a little bit color in terms of how the corporate bookings have been for Diwali, how your air fryer has done?
No, if you only talk about the air fryer, of course, we did not plan enough, and so we were a little stocked out for this item. But overall, I want to convey that the demand has continued post the quarter, and the season has panned out. The festive season has panned out well so far.
Understood.
There has been very good demand.
Sure. And sir, would it be fair to say that air fryer as a category for you would be a high margin product compared to your overall blended margin?
For us, we are agnostic on margins, whichever product or category of products it is, and also the channel. But when we move to this completely manufactured status, that is, we do introduction of new products in 3 stages. Initially, we trade in them, then we manufacture, and we completely. So air fryer is one category where we fully make the whole product, and obviously it will be a little relatively higher than our general business margin.
Understood, sir. And sir, you mentioned that exports as a revenue contributor is 10% to your consolidated revenues. So can you call out what has been the export growth on a YOY for 2Q?
For the quarter, it was subdued because we are actually developing new products in line with the global trends. So for us, exports majoritarily contribute from the non-stick cookware category, and but the non-stick the cookware is moving to a different coating category now. So we have equipped ourselves based on the consumer discussions that we have had, and we have set up new lines catering to this new type of cookware, and we also have good orders. But all this will start delivering from the third quarter. I can say revenues will start recognize revenues from the fourth quarter of this year, particularly in the cookware category. So there would have been muted growth in the export business in the last quarter.
Understood. And sir, how many stores would you have converted from the COCO to COFO model in second quarter?
We have 12 stores only in the second quarter. No, this is September 14. 30. See, of the 213, I can say 35 stores, 38 stores are not COCO stores. We have 35 COFO and 3 FOFO. 38 stores we have converted.
Okay, and the remaining would be your COCO?
Yeah, remaining 175 are COCO. So we would want to cap this at 171. So the way it works is we continue to open stores under the COCO model, and stores that are matured move to the COFO model.
Got it. And sir, one last question before I get back in the queue. Sir, what is your current touch point in terms of your distributor, dealer, and retailer count?
I don't have exact numbers, but we have about 75,000 retailers on the for the Pigeon brand through the distribution GT channel, and we have about close to 600 distributors. But these are not exact numbers. These are approximate numbers that I'm giving you.
Understood, sir. Thank you. I'll get back in the queue.
Thank you. We have the next question from Mr. Yash from Maximal Capital. Please go ahead.
Hello. Hello. Am I audible?
Yeah, please.
Yeah. Thank you so much, sir, for the opportunity. So I just wanted to first ask you about the volume growth that we are projecting for the year. The guidance was around 14-15% for the volume to grow, and incrementally 3-4% would come from pricing, which is not in our hand. But sir, in at least first half, and by first half it includes Q2, which is strong quarter for us, the volume growth has not been great, where we could project that 14-15% volume growth is still feasible for the entire year. So does our guidance for the whole year change, or we still maintain that and are confident of achieving growth more than 15% in second half to compensate the whole year?
So we believe that the demand continues to be stronger than even the second quarter. So we are very confident of delivering better than the growth that we were able to do in the first half, and definitely will beat the industry growth by 7-8% definitely.
Okay. Thank you so much, sir. And sir, the second question on the retail store side, what is our SSSG for stores which are now older than 1 year on this quarter?
They're definitely performing better than the new ones. Currently our average, for the last H1, the average is 3.56 lakhs. Of course, it is improving. But our greater than 1 year stores are delivering upwards of average of 5 lakhs.
Okay, so it has definitely grown from where they were earlier.
Yeah.
And so incrementally, are they becoming EBITDA positive for us?
For us, the whole retail channel is EBITDA positive.
Even the new one, or the COCO side, on the COCO side.
So if we find any store which is not only EBITDA positive, I can say net cost positive beyond 6 months, then we relocate. We would not want to continue that location.
Understood. Great, sir. Thank you so much.
Thank you, sir. Participants, if you wish to ask a question, you may press star and 1 on your touchtone phone. We have a question from the line of Chirag Jain from MK Global. Please go ahead.
Hi, good evening, sir. Thank you for the opportunity and fairly strong set of performance in a challenging environment. Sir, just wanted your thoughts. I think in the media interview you mentioned that our business could be in the range of the EBITDA margins could be in the range of 11 to 14% over the medium term. If you can share some thoughts around this as to how we see, let's say, our business progressing, especially on EBITDA margins over the next 3 to 5 years, that would be very helpful.
Thank you, Chirag. Of course, very challenging question, but I tell you where we are heading to. We are improving both as the operational leverage gets in. Our cost will get spread over the overall revenue. So operational leverage, we see that improvement coming from that, and of course on our gross margins, because more and more products are now being manufactured within the facilities of Stockcraft. Our gross margin also, we believe, will also improve. So with these two both totaling up, so the average number will hover between that 11 to 14. We believe definitely in the medium term, between 3 to 5 years, we'll definitely hit that 14%.
Okay. And in terms of your current set of infrastructure, manufacturing infrastructure, what kind of revenues we could do, let's say, assuming there is enough demand over the next 2-3 years?
Revenue?
Yeah, revenue potential that we have from the current manufacturing setup.
If there is no new addition, with only operational, maintenance capex, we should be able to get to double the revenue of this year's revenue.
Okay, so there is a big scope for operating leverage ahead in terms of the infrastructure investments that we have done over the past few years.
Yes.
Yeah. Also on the export front, you mentioned that we could be 16-17% of the revenues over the near term, and especially with the addition of new players. Can you throw some light over here? I think we already supply to Walmart. So any new customer addition, major addition that is happening or already in the process, if you can share some thoughts over there?
Chirag, I want to tell you that Walmart is publicly announced that they would want to buy more and more from India, from their current 3 billion to 10 billion. They consider us also one of their strategic and important suppliers. They have also given us new lines, for which I mentioned that we have set up facilities for the new coating lines. And with that, the revenues will start pouring in from the Q4 of this financial year. And we are also in talks with it is at very advanced stage. It's not that we have closed the agreements with them. It's a very advanced stage of discussion with a large global retailer. And we are very confident that with these two additions and with the growth that is already happening, we will be able to, on an increased revenue base, hit a 16-17% contribution from our exports.
Okay. Thank you so much. That's it from my side. And best wishes for the festive.
Thank you, sir.
Thank you. We have a question from the line of Mr. Hitesh from Kosha Capital. Please go ahead.
Hi, thanks for the opportunity. Sir, on the demand front, would it be possible for you to give a sense how the demand is across different product categories like the cooker, the cookware, small appliances? If you can give some sense on how this demand has been in this festive season across categories.
So primarily for us, these are three categories. The cookware contributes both the pressure cooker and non-stick cookware. The cooktop contributes gas stove and induction cooktop. And then is the rest of the appliances. The appliances definitely is growing faster for us because of the strategy that we have adopted. We have started manufacturing these. Most of the appliances are got to a stage of complete manufacturing within the facilities of Stovecraft. So what used to be the largest category, the cookware category, is now replaced by the appliances category, followed by cookware, because pressure cookers, of course, we have again started growing now. In absolute numbers, we are already getting to leadership now. And the cookware, both with the new lines for our exports and the completely automated line for our caster, with our caster and foundry, we will again we will see good growth coming from our cookware category also. On the cooktop, we have completely exited the co-branded business with the oil companies. So today we only cater it to the consumers who are directly buying these gas stoves. So, but our induction cooktop also, we are by absolute numbers, we are at leadership position. Both these, the third category that is contributing to our revenue is the cooktop category. To answer your question, the highest contribution, the highest growth will come from our appliances category.
Sure. And does this have anything to do with the BIS standards which have kicked in? And if you can also comment how the industry is trying to cope up with the standard. Are there a lot of inventory that has already been built up by players, and hence the impact of this could come with a lag? Or do you see this benefit coming to you in the near term itself?
I can tell you that we are fully equipped today. We don't have to depend for any of these product categories that we wanted to be or we already are dealing in, to depend on any completely built unit for our or import any of this. So today we have BIS licenses for across all the product categories that we operate in. Definitely, I am sure it's not only about getting advantage because of the supply disruption, But there is also an advantage that because we have the capability to make it within the facilities of Stovecraft, and with the aggressive price point that we operate in, definitely we have a edge over competition. There are some categories that we have again in the recent times started manufacturing. I'll name one, that is OTG that we used to in the past import and sell. We are already doing more than 10x of the business that we were doing in the past, just because we started manufacturing them. So there are many of these categories, like you said, maybe people would have stocked them and all that. But as in the days to come, with the QCO order strictly being implemented, definitely Stovecraft has the advantage of manufacturing them, and we have a ready consumer in various channels to operate to cater to the consumer requirement.
Sure. And sir, my last question is if you can also touch upon how the demand is for the premium vis-a-vis the mass economy segment. Any change in the trend, any different trends that you're seeing across the two segments? Premium vis-a-vis the mass? Yeah.
Stovecraft makes premium products. The pricing is not premium. We make products with completely stacked features, high quality. We don't compromise on them. It is definitely not priced at the level of generally what so-called premium brands price them. But the products are not. So we make, example is our air fryer or our new vacuum cleaner or the electric pressure cooker that we make, or any of those products. They are all feature-wise, quality-wise premium products. So today the Indian consumer is we still believe the Indian consumer for a long time will be cost conscious. And if they see value in these products, the larger category will opt for this category of products. And so we actually make premium products. These products are not sub-premium.
Okay, sure. And so this whole export strategy that you are adopting, would this be sold under Stovecraft's name, or would it be white labeled products that you'll be supplying to Walmart and the other retailer that you were mentioning?
The current exports to retailers like Walmart, these are all white labeled. We also have our brand exports, this catering to the Indian diaspora, but it is relatively small. Maybe in the future when we start our exports e-commerce play, the brand exports will start contributing. But today, the arrangement with these retailers like Walmart is all white label.
Sure. Thank you very much, sir.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 on your touchtone phone. We have the next question from the line of Mr. Pritesh from Lucky Securities. Please go ahead.
Yeah, sir. Good afternoon, sir. My question is with respect to the other expenses. So first of all, congratulations for taking the GP up on the last 12 quarters that I see. You have obviously moved your gross margin from 32 to 38%. But it's surprising that nothing of it has flowed to the EBITDA. So on the other expense line, if you could tell us on a YOY basis, the key cost item and what is the movement, and why is it that this 600 basis point, is not flowing through the EBITDA, and this observation is not for this quarter, let's say 12, 13 quarters I am trying to assess and ask you.
Thank you, Priteshji. Of course, as you have well understood, we have improved on our gross margins. The impact there is improvement in EBITDA. Definitely there is an improvement from EBITDA. We were at about 8.4%. We have moved to 10.7%. But it's not reflecting on our PBT or PAT. Three major reasons. One, of course, in this quarter we have had some one-off costs that was linked to both some capex derailment, I can say. Not capex, brand derailment, and one forex loss on capex. That is approximately 2.6 crores. The second expense was we continue to open stores, and we did some lease financing of our capex to the extent of about 32 crores. So this gets written off completely during the period of the payment of this lease. So this is less than 5 years. So this is a little pre-ended cost, I can say. To that extent of about 5 crores, what you see, there is an additional notional cost that is being incurred in the post EBITDA number.
No, I am asking you everything pre-EBITDA, nothing post-EBITDA. So pre-EBITDA, if you could tell me the other expenses movement from 52 crores to 65 crores, same quarter in 2 years.
So, yeah, Ramakrishna will.
The other expenses have gone in line with the sales growth. So basically, we have spent some additional marketing spend of about 3 crores, and then the outward freight had gone up by 3 crores compared to YOY basis. And then we also have we are increasing the retail stores, and then the retail stores had these salaries and expenses to the extent of 1.7 crores. There is an increase. And then as per the accounting standard, job work charges are reported as other charges. The data, there is an increase in line with the sales growth. So overall, about 10 crore of expenditure have gone up. But those are all, we see that it is in line with the sales growth.
Sir, your expense is up 25%. You are making me count all the expenses which are in line with sales growth. There has to be something which is outside the sales growth, right?
The marketing expenditure which we spent may not be for the month. Of course, that sales gets realized in the subsequent months as well. Of course, yes, I agree with you that it is not in proportion to the sales growth. But yes, these are all the expenses directly linked to the sales.
So let me broadly.
So should I conclude this way that there is no operating leverage in your model at all?
No. I think the understanding is not correct. There is an operating leverage in the model. There has been front-ended costs. Most of it will reflect in people costs because we have all the manufacturing facilities will get fully operational, but we have invested on all of them. So definitely there is a front-ended cost on the people cost. What Ramakrishna said is some investment has happened in marketing, additional marketing spend, but that is for the future. And in the one-off item is that 2.6 crores additional cost that has come in this quarter.
Okay. Sir, you have beautifully managed your growth for all these years. You have created a very good backward integrated capacity. You have gone through the good round of gross margin expansion. The only thing which is probably left is to get operating leverage in the model. You are far ahead in terms of competition in your thinking. I think, the last thing is that, these things should now translate into operating numbers and operating leverage. So in your opinion, when should it start getting fully reflected?
I think you will start seeing immediately from this quarter, but it is not that it will be the complete stack that we want to do. If you really want to see that, I think you will have to have patience for the next 4 to 6 quarters. But you will start seeing that operation leverage panning out immediately from this quarter, Q3.
Okay, sir. Yes. Thank you very much, sir.
Thank you, sir. We have the next question from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. Thanks for taking my question. So my first question is on similar lines from the question of earlier participant. So when I look at your EBITDA margins and, it's close to 11-12% for this quarter. And when I look back into Q23 and 2Q22, you had done similar margins, but which was on a much lower gross margin base, say 33-34% gross margin base. So now I want to understand this cost structure better below gross margin, from gross margin to EBITDA margin. So if you could just explain why are we not seeing this flow through, because on 32-33% gross margin we have done 11% of EBITDA margin already, and now at even 38% gross margin we are still at 11-12% EBITDA margin.
So it says on the same line, but let me repeat. So there is a one-off cost in this quarter. Definitely that is giving you some drag on the EBITDA margin. Second is we have fully equipped the whole manufacturing facility, and that while the capex is done, all that will start reflecting in increased revenue and increased gross margin. So that is to start. It is started, but it's not that completely it is reflecting in our numbers. So there is a people cost increase. It is not in proportion to the growth in business. So, but that business growth is ahead of our cost.
Right. So, okay, two follow-ups on the same. So, can you just explain me what percentage of your other expenses would be variable in nature, which would be linked to, say, sales?
Almost you can consider as we go forward 2% improvement in our overall expense after the gross margin.
No, sir. My question is, what percentage of your cost other than the employee cost is, variable or is linked to sales?
Variable cost is not only the employee cost. In fact, employee cost.
No, I'm saying except employee cost, all other costs. What percentage of that would be, say, variable in nature, and what would be fixed in nature?
20% is variable.
Only 20% is variable. Yeah. Okay. And my second question is, in terms of employee cost, are we done with hiring whatever the employees we had to hire, or we are still looking at hiring more, and this cost is?
We have the complete team in place, both for our manufacturing and the other operations, corporate operations of a company.
So this should not increase, X of just the, say, yearly increment that happens, the employee cost?
We believe that there is no other increase other than the inflationary increase that every year we'll have to.
Okay, sure. That's it from my side. Thank you.
Thank you. Next question is from the line of Harsha from Rira Holdings. Please go ahead.
Yeah, hi sir. Good afternoon. Sir, can you give us the absolute volume data for current quarter, preceding quarter, and YOY quarter?
No, you want absolute number, or you want
absolute number in terms of million units?
Value, you want the absolute value or volume?
Million units, the volume which we have sold.
Okay. Yeah, while it is very competitive sensitive, still I'll share it with you. There's no problem. For the quarter, we were at 14.8 lakh units for pressure cooker. For cookware, we were at 26.75 lakh units. For gas cooktops, we were at 2.5 lakh units. For induction cooktops, we were at 4.99 lakh units. For all the small appliances put together, we were at 55 lakh units. And of course, the LED, we were at correct, the small appliances was at 31 lakh units, and for LED it was 14 lakh units.
Okay, sure. And sir, can you elaborate it a bit more on the gross margin part? I mean, is 30% peak margin, or can we improve further from here? Because you said that we'll do more in-house manufacturing, but we are already at around 90-93%.
Your voice is cracking. Can you please repeat?
Is this better?
Yeah, it's better now.
Yeah. So my question was, in terms of gross margin, can we take the 38.5% is the peak gross margin, or we can improve from here on as well? Because you mentioned that we will be doing more in-house manufacturing, but we're already at 90-93%.
Yeah. So when I say complete manufacturing to manufacturing, there is a difference. Most of the products we are getting to complete manufacturing, and our endeavor is to improve from here. This is where we wanted to first get to, and I think we have achieved what we wanted to. But there is a scope for improvement, and we are confident to improve from here.
Okay. And sir, have we taken any price hikes or price cuts during the quarter? I joined the call late, so I might have missed that.
We have been continuously trying to adjust our price to get to the gross margin that we aspire to. So I think we are there. But we also believe that there is scope without actually penalizing our consumer. We can still have better margins. So we are working on that. I'm sure in the quarters ahead you will see little improvements gradually on our gross margin.
Okay. And sir, is there any element of manpower cost that sits in your other expenses?
No.
Yeah, because you mentioned that.
One small portion. Say the retail sales team, which are not directly on the rolls of the company, this gets into the other cost. Yes.
And roughly how much that would be?
I'll give you a number exactly. Just a minute. 1.7. 1.7 crores for the quarter.
So is that incremental in this quarter? It's been there always, this 1.7 crore number.
The incremental, yeah, it's incremental for the quarter.
Okay, sure, got it. Thank you so much, sir.
Thank you. We have next question from Resha Mehta from Green Edge Wealth. Please go ahead.
Yeah, thank you. So the first question is on the general trade channel. So have we seen the pressure on this channel having eased or any change there? Because this channel has been under pressure for quite some time now. So how are you reading it, and especially in light of the current festive season panning out?
Yeah, for the period that we have reported, we were seeing pressure on the channel. But I think the channel has come back strongly in the festive period post the reporting period also. So I think that is getting back to normal. It was experiencing some pressure. It was actually a lower contribution. So our GT contribution for the period reported is only 28%. Normally it used to be above 30%, in the range of 30 to 35. But we believe that as the festive season is panning out well, the GTS, general trade channel is also contributing well. So I think the pressure is off now.
And what about the rural MFI channel?
The MFI channel is going through, because of the restrictions pre and post election period, it has to come back to the normalcy. It is not at the level it used to be.
Got it. And in exports, we were to enter the UK market in this financial year. So has that happened?
We have started working. We are working with the largest retailer there already.
Okay, so we have started exporting there. And on the balance sheet side, so just wanted to understand that how many of our partners, would now be covered under channel financing?
Majority of the business, both for terms of safety, all our channel financing arrangement is without recourse, and almost all of our business are covered through channel financing. There could be some players, wherever we are very confident that we do business directly. But in the course of the business in the quarters to come, 100% of our domestic business will move to channel financing.
And what would that be at current levels? So we are not yet at 100%. So
no. So there are two type of customers that we work. Very short term credit, like 7-15 days. We would prefer that we cater to them directly, and so that could be almost say 50% of our business.
Okay. On the debt side, so I think I missed this. So we were to reduce our fund-based debt almost zeroize this zeroize
All
that
the
this
capex
financial year.
so far, all the capex so far, all of that capex has been funded from the balance sheet for the company, and so the contributions have been utilized for this. So, but we have, in spite of the growth in the overall size of the business, we have maintained the debt at that level. You will start seeing reduction in fund-based debt in the quarters ahead.
And about this BIS certification, can you just elaborate, I mean, in terms of the industry's, the entire industry's readiness towards this compliance, and how can it benefit us and how can we leverage that? Because my understanding is that for a lot of the product categories that we are already in, there's not much high import.
No, most of the appliances in this country, which would not have very large scale, most of them, it was easy to import and sell as more of the kind of a trading commodity. Several of them were 100% imports. Most of them had both domestic and import content. Today, if somebody has to be serious in that category, the only way is they have to manufacture. In the worst case, at least assemble the product within the country. Only then they can have that BIS certification and sell.
So how would you say is the industry's readiness? The local small manufacturing units or, the smaller brands that are there, they already have these certifications in place?
Not all the categories. There are some categories where very less manufacturing existed in the country. To just name some of them, I'll tell you. Hardly any air fryer manufacturer. There was hardly any chimney manufacturer. There was hardly any OTG manufacturer. So it's not only these, not limited to these, but there are several of these categories which of course, when we believe that as the need is arose now, there will be more and more manufacturers. But today, we are ahead of the curve. It's not that we'll be the only one to be manufacturing this product. And when we get into manufacture, we get into the complete.
Hello?
Sorry to interrupt, ma'am. The line for management has been disconnected. Please give us a moment while we connect them. Ladies and gentlemen, please stay connected while we reconnect the management.
You are joined to the conference. The conference has not been initiated. You will be placed on hold until the chairperson arrives.
Ladies and gentlemen,
Hello?
ladies and gentlemen, ladies and gentlemen, we have the management online with us.
Yes, I was asking on the BIS certification part, and so just this last one there, that when is this expected to be enforced?
So there are different products at different stages. It's not that all of them are, but at the moment, the way it looks, unless it is extended, in the next 6 months, all of these products, any of the kitchen appliances, have to be under the BIS.
Right. And lastly, I just wanted to understand our sales model. So is it that the same salesman actually goes to, a GT channel and sells all the products that we have in our portfolio, or have we, defined some categories across our sales personnel?
So for us, all these categories fall under the same channel, and the salesperson who is for that area, whichever area is catering to, will go to all the stores that are dealing with our products. Not necessarily every dealer will deal with the complete range. There could be different dealers dealing with different products, but for that region, he will be the salesman. We do not have multiple salesmen for different products. At the moment, we don't have that strategy.
All right. Thank you. All the best and Diwali wishes to the team.
Thank you, madam.
Thank you so much, sir. Participants, in order to ensure that the management can address all the questions, I request you to please limit your question to 2 questions per participant. We have the next question from the line of Shreyans from Swan Investment. Please go ahead.
Hello. Festive greetings to the team. Hello.
Yes, sir.
Hello. Yeah, festive greetings to the team, sir. Sir, my first question is, you spoke about improving gross margin, but I'm just trying to understand, sir, we are already at 92% in-house manufacturing, and we're not increasing any capacity going forward. So how will our gross margin improve? So I think there are only 2 ways out. Either you improve your product mix or you take price increases or premiumization, as you call it. But I think you've not spoken on those 2 lines. So how will we improve our gross margin, sir?
Obviously, we definitely intend to improve our price structure, because we feel there is a lot of flexibility there. We are very aggressive in our pricing. We would definitely not want to tax our consumers too much, but very small increase in our prices in whichever categories we feel we are bottomed out on our cost. So we'll definitely have price increase there. And when we say 92% is manufactured, this is just we are getting there now. We have got there. There's still improvement in getting to 97, 98%. But as we manufacture more and more of that product within the facilities of Stovecraft, our gross margins will also see improvement.
But sir, because of these efforts, what kind of improvement can we build in? Like, do you think we can improve from 38 to 42, 44%?
I don't want to guide you to 42, 44 today. In the next 4 to 6 quarters, you can definitely expect us to deliver 40%, if not better than that. But 40% is what you should expect us to deliver.
Okay. And my second question is for the CFO. If you go to see our notes to accounts, note number 3, sir, can you explain what does that mean? Derecognized 132 crores, or I'm not sure if it's 13 crores, AS 109. Sir, can you explain that note?
That is, we are doing channel financing with one of our channel financing partners. So that sale, whatever we discounted through them, that was not part of the receivables. So that's what is called as derecognition.
So does it impact the P&L in any way, sir?
No, it's a balance sheet item. So to this extent, the receivables was transferred to channel finance.
Okay. All right. Thank you so much, and all the best.
Thank you so much, sir. Ladies and gentlemen, in the interest of time, we take this as our last question for the day. I would now like to hand the conference over to Rajendra Gandhi, sir, for closing comments.
Thank you, all of you, for your patience for listening to us. I hope we have addressed all your questions. But if you have any further inquiries, please feel free to reach out to us directly or contact our investor relationship partner, Orient Capital. Thank you. Wishing you all a very, very safe and happy Diwali. Thank you again.
On behalf of Stovecraft Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.